Hello and welcome to another episode of All Things Policy. I'm your host,
Welcome to All
Shrikrishna
Things Policy,
Upadhyaya,
a daily
and my
podcast
guest today on the
supported by
show
Pragati,
is Shantanu
a
Srivastava,
flagship
who
media
is an
initiative
energy
of the
finance
Takshashila
analyst.
Institution.
He's currently working with
We're
the
a bunch of
Institute for
policy
Energy
nerds based in
Economics and Financial
Bengaluru,
Analysis.
and we like to
He
bring a
covers
fresh
listed
perspective
companies
to
in the
Indian
Indian
affairs
energy sector.
and an Indian
He analyzes their
perspective to global
transition
affairs.
and
So
growth
grab a cup
strategy,
of coffee,
their financing
sit
needs,
back, and
and
join
their
us for
ESG
today's
profiles.
chat.
Today, we'll be having a chat with Shantanu on sustainable financing and something which happened very recently, which is the issuance of sovereign green bonds. Welcome to the show, Shantanu. Happy to have you on All Things Policy.
Thank you, Shrikrishna, and great to be here. I've been following your podcasts, and they're very valuable in terms of the topics that you explore. And I think sustainable finance and specifically sovereign green bonds is a topic which a lot of people do not really understand. So great that you're having this conversation to demystify this particular topic. Just to brief about my background and the kind of work that I do. So, like you mentioned, I work with the Institute for Energy Economics and Financial Analysis. It's an energy finance think tank. It's based out of the US, but it has regional offices across the world. So I'm part of the India team. And besides tracking sustainable finance for listed corporates in India, I also try to understand how well can we develop the ESG ecosystem, something that probably we're going to explore more as part of our conversation. But what can be done to broaden the ESG or develop the ESG ecosystem within the country to make sure that more sustainable finance comes into the new renewable energy assets that are being developed. Besides that, I also look to or research about climate risk faced by financial institutions in the country and the development of taxonomies, which are really going to help channel more sustainable finance into clean energy assets. That's a bit about the kind of work that I do and the sectors that I cover.
That's great. So I just had a quick question on ESG itself, right? So this is a buzzword we've been hearing so much these days. So if you had to tell our listeners very briefly, what is ESG? How would you put it across in, say, like just a couple of lines?
Sure. So, see, ESG is a word that is being thrown around a lot. And I think today, as ESG stands, it's colloquially used with sustainable finance, it's colloquially used with CSR, and it's also used with other forms of responsible sustainable investing, such as SRI or sustainability, socially responsible investing. Sorry, but ESG is essentially an investment industry term that was coined by the investment industry to invest in assets or activities which align with the environmental, social, and governance requirements of a certain set of investors. For example, if you talk about renewable energy assets or RE assets, example solar generation or wind generation, these assets rank high on environmental factors, right? They end up improving the carbon mitigation by a particular amount. So because these rank high on E factor of ESG, they are favored by a certain set of investors. So end of the day, ESG is nothing but scouting for investments or activities which rank high on either E or S or G or a combination of these three different factors.
Thanks for that succinct explanation of ESG, Shantanu. I'm much more clearer now when I use that term. So let's jump right into today's topic of discussion, right? So I wanted to ask a very basic question. At a fundamental level, what is the link between finance and climate change? And when we use terms like sustainable finance, what exactly do we mean by that?
All right. So if you talk about climate change, right, essentially what we're trying to do is trying to make sure that the world as a whole stays on a trajectory, which, as all of us know, as part of the Paris Agreement, that was either 1.5 degree trajectory or 2 degree trajectory till 2050. So in order to make sure that the world stays on that 1.5 degree or 2 degree trajectory, we need to make fundamental changes in the world economic order. For example, we need to decarbonize the power sector, which is across the world the biggest polluting sector. In order to do so, we are installing more and more renewable energy assets, solar, wind, and other clean energy assets. This is one. Secondly, at the same time, we also want to phase out high carbon emitting assets such as thermal power generation assets or gas or oil and gas assets. So that's the second fundamental shift that is happening. Thirdly, we also want to go beyond decarbonization of the power sector to decarbonization of the economy as a whole. And that is where decarbonization of other high emitting sectors such as steel, cement, fertilizers, plastics, refineries, all of this come into the picture. So that is the other set of activities that need to be done to make sure that we stay on that climate trajectory. And lastly, we also need to develop new solutions for decarbonization of the economy as a whole. For example, a lot of us are hearing about green hydrogen and its potential to decarbonize Indian economy and global economy as a whole. You also have other solutions such as carbon capture, utilization, storage. You also have battery storage. Now, all of these changes or all of these things need to stack up in tandem, right? So that as we move ahead, as we try to move to on that 1.5 degree, 2 degree trajectory, we do not leave any aspect behind. All these four changes that I've listed, they required financing as a core requirement. So in that sense, financing becomes key for us to make sure that we stay on that climate trajectory. And that is where, finance and climate change are intertwined as we try to decarbonize or as we try to make sure that, the world as a whole stays on that particular path. So I think that's where climate and finance meet. To answer the next part of your question, what exactly is sustainable finance? I think when we talked about ESG, that I partly answered that question. But very simply, sustainable finance is providing finance for anything which, among the four set of requirements that I've listed, financing any of those can be or is going to be counted as providing finance for sustainable activity and hence sustainable finance. So, for example, RE generation is something that would count as sustainable finance activity, but electric mobility is also another sector which is going to be counted under sustainable finance. So is green buildings, so is green steel, green cement. All of this can be counted as sustainable finance. So end of the day, whatever activity helps us mitigate or adapt to the ill effects of climate change can be counted as sustainable finance.
Right. So the way I understand it is climate change, of course, is it poses a structural problem to us. We in most of our conversation talk about what individuals can do to fight climate change, how they can engage in climate conscious behavior, but it is more important to perhaps think of it in structural terms. And the challenge there I see is humongous. Like you mentioned, it is not only about transition of energy from renewable to non-renewable or from fossil fuels to other sources, but the challenge is about decarbonizing the entire economy. It is about buildings, it is about steel, it is about chemicals, and so on. But now, of course, that's where the financing aspect comes in. So financing is essentially about raising funds for fundamentally redesigning and transforming your economy. And let's look at the specifics in our country and have a question to ask you about that. Because India is one of the largest polluters given our size and population and the fact that we are a developing country and we need to burn coal for our energy needs as of now. But at the same time, India is trying to be very ambitious in setting its climate targets. So we want to install 500 gigawatts non-fossil fuel capacity by 2030. We plan on generating around 50% of our energy requirements from renewable energy by 2030, and we want to achieve net zero emissions by 2030. And some of these are big goals, right, for a country as large as India. And I believe this would again require us financing for both the public and private sector to carry out all the activities that you spoke about in order to meet these goals. So, could you maybe throw a little bit more light on the financing challenge that India faces? And maybe later on, we can sort of place green bonds and sovereign green bonds in this context, if I understand correctly.
Sure. And as you rightly mentioned, India has a humongous challenge ahead of itself, and it has very ambitious goals also, right? The 500 gigawatt target of renewable energy by 2030, or 50% contribution of non-fossil fuel sources in the power sector by 2030. These are very ambitious goals, obviously, and given the size of India, these were required in the first place. But again, all of these changes, and we're just talking about over here in terms of decarbonization of the power sector. India also has a very ambitious goal when it comes to decarbonization of hard to abate sectors. And that is where our goal of 5 million tons per annum of green hydrogen production also comes into the picture by 2030. So we are, moving on on fronts to make sure that we achieve our long-term goal of net zero by 2070 and also our intermediate goals for 2030, 2040. And as you mentioned, all of that requires a lot of financing. Now, the challenge with India, or for that matter, any developing economy, is that the financial wealth globally, as it stands today, is divided disproportionately among the global south and the global north. So majority of the financial assets today are with the global north, and the majority of the developments or changes or decarbonization efforts that need to take place, or rather, let me put it this way, majority of the development going forward in the world economy is going to come from the global south, countries such as India, Brazil, Indonesia, even China. And in these parts of the world, you do not have the financial assets, first of all, to really support the humongous targets that are required to be met to decarbonize the economies. So fundamentally, as we stand over here, India really needs to make sure that besides domestic financial institutions, besides our pension funds, our insurance companies, we also tap into the financial pool of capital that is available globally to make sure that we do not fall short of financing as we move forward in terms of achieving our ambitious decarbonization goals. So the first point is we do not have simply the financial assets within the country to make sure that we achieve our goals. Now, second thing is within the financial assets that we have available, right? Let's talk about the LIC or DPFO of the world, which are some of the biggest investors in the country, right? Now, while they have a lot of investment capital available with them, so as or rather you can call it financial gunpowder with them, but they are not inclined, or in terms of their investment decisions or mandates by the regulators such as IIDAI or PFRDA, to provide capital for any kind of green financing activities. So if you talk about an LIC, its investment guidelines, which are dictated by IIDAI, which is the Insurance Regulatory Department of India, it does not facilitate, or it does not nudge the LIC to provide capital for any kind of low carbon technology. So there is no incentive for LIC to put money into any green bonds which has been locally issued, or any kind of green hydrogen project that has been taken up. And that is where it also does not give any weightage to any green bond issuances. So there is a new term that I'm going to introduce, that is known as greenium. So a greenium is the excess premium that a particular investor gives to a particular bond issuances over a normal bond issuance. So for example, if a normal bond issuance happens at 7%, that is the 7% return is something that is being accepted by a particular investor. A green bond issuance probably might happen at, let's say, 6.95%. So that 5.5% difference is the greenium which a particular investor is ready to pay because they're inclined to invest in a particular project. Now, an LIC or an EPF, or for that matter, majority of domestic investors do not give any kind of weightage to that kind of a greenium. So whatever financial wealth we have available, it's very difficult to mobilize those funds also, that financial wealth also, to finance our ambitious renewable energy goals. So that's the second point. Third point, I think the third problem that India has, or the challenge that India has in terms of achieving providing the financing for its decarbonization goals, is that the Indian market, like majority of the emerging markets, is driven by bank financing, right? So majority of our infrastructure assets are funded by domestic banks, the likes of SBI, ICICI, HDFC, all of these, and a large set of NBFCs that we have here. Now, ideally, in an ideal world, infrastructure assets such as renewable energy should not be funded by bank loans. The most appropriate mechanism to fund those assets is through the corporate bond markets. And in countries such as India, these markets are at a very nascent stage of development. So only a few issuers, 10, 15 top issuers, majority of them being PSUs, are able to tap into the corporate bond market in the country. Now, because we do not have the well-developed and well-functioning liquid corporate bond market, majority of our infrastructure needs, and now infrastructure needs for green infrastructure, are being met by bank financing. And banks essentially do not they do not want to fund long dated assets which are going to last for 25, 30, 40 years through their own balance sheets, because there's something known as an asset liability mismatch. I'll probably not go into the details of it, but there is an essential asset liability mismatch for banks, and that is why these are not the right set of players to provide financing for long dated infrastructure assets such as renewable energy. And that is where the third problem is. And that is where we really need to develop domestic corporate bond markets to make sure that long-term financing is available for us to finance this energy transition or decarbonization as a whole in India. So yeah, these I think are the three major fundamental problems that India has when you talk about financing of its ambitious decarbonization goals.
Wow, so there's a lot to unpack there. So just on the bonds, but taking it first. So I'll try and simplify it a little, and please correct me if I'm wrong. So essentially, what you're saying is the companies, of course, who are working in this renewable energy sector, for example, or any other sector which is doing some amount of climate mitigation, they require a lot of funding. So an easy way to do it is, of course, go to the banks, but the banks are unwilling to fund something which has a long asset cycle, essentially because they are not willing to expose themselves to that risk. So instead, we need to have a mechanism where we can let these companies borrow directly from institutional investors and retail investors. And that's where the bond market comes in. They can issue bonds, and bonds are a win win for both the company and the retailers, because the interest rates in a bond benefit both sides, essentially, because you have taken the banks out of the equation. And that's what makes bonds attractive. And I think that's the funda behind what you've just spoken about. And coming to green bonds specifically, right now, this is a new type of bonds. Of course, India has had a lot of corporate bond issuance. Our markets are not as developed as they should be, but green bonds have also entered into the picture. I think some Indian companies have already issued green bonds in markets abroad. I don't know if issuances have happened in India. Please let me know if they have. But on green bonds specifically, I want to ask you that, when did this concept come in? When did the idea of, say, greenium that you mentioned come in? And how has the development of green bonds taken place over the years hence?
You're absolutely right in demystifying what exactly is the reason why banks are not willing to fund these green infrastructure assets, and that is where these green bonds enter. So if you see majority of clean energy developers in the country, what they've done is they've taken bank loans to finance their renewable energy assets during the construction stage, and then they've gone majority 90% of the green bonds in India that have been issued, or rather green bonds issued by Indian developers, these have been issued in the foreign markets, right? And I'll probably just talk about why that has happened. But what these developers have done, that they've, once the construction is done, once the project is operational, they've refinanced their existing bank loans that they've taken from the likes of SBI with green bonds, which they issue for 3, 5, 10 years, and where you are essentially going to institutional investors such as pension funds, insurers, sovereign wealth funds, foundations, which are ready to take exposure to such kind of infrastructure assets, where banks probably might not want to take that exposure for a very long period of time on their books. And that is where green bonds become extremely important to finance these assets. Now, from an Indian perspective, I would say there have been only 2 or 3 issuances in the onshore market, that is in India, right? But majority of the green bond issuances, and I think in 2021, I'm not really sure about the 2022 market, but in 2021, green bond issuances from India stood at somewhere around 13 to 14 billion dollars, and these are just green bonds, right? So majority of the issuances by Indian developers or the industry, and also there have been some municipalities, for example, Ghaziabad municipality, these have issued green bonds in the offshore market.
Yeah, I think Indore also just issued one yesterday, I think. If I'm not wrong, there was some news report that I read that, Indore Municipal Corporation had also issued some green bonds. So yeah, this topic is very much in the news. But yeah, please continue.
Definitely, yeah. And that's a very interesting development, because you need municipalities also to, step up their game and, have the financing required for them to also transition, right? And like I mentioned, the bond markets are a very appropriate, place to really go and provide financing for such decarbonization efforts. But yeah, I was saying that, the majority of the green bond issuances that have been done by Indian players have been done in the offshore markets. Now, the reason for that is, and this goes back to one of the things that I've said previously, that in India, investors do not differentiate between a green bond and a non-green bond. So there is no concept of greenium in India. Now, why is there no concept of greenium in India? Is because there is no, so as to say, pressure from the regulator or pressure from the investor, or any green mandate that majority of Indian investors have, which would nudge them to provide financing for or provide a certain greenium for any kind of green bond issuance. And because you do not have, and why do you want to fundamentally, just answering this question, why do you want to issue a green bond? The reason, and that's compared to a normal bond, the reason why you want to issue a green bond is because there is a certain pricing benefit that you would get in, for example, in terms of lower interest rate, right? Or let's say other benefits are non amortization period for a certain years, but essentially it's the greenium, right, that a particular issuer is after. If you do not find that greenium with the investors, you would want to find those investors or issue the bond where that greenium is there. And most of those investors are situated in the EU or the North American markets. And that is why majority of our issuances have been in the offshore markets.
Right. So is it because we don't have enough climate conscious institutional investors that the concept of greenium does not exist here, or is it something to do with the regulatory structure?
So I would say it is both. So if you essentially see, and I mentioned that, pension funds, insurers, these are the biggest institutional investors globally. In India, also, the pensions and the insurers are the biggest institutional investors. Now, for them, globally, what we've seen is that they are basically stewards, or they're managing capital on behalf of their ultimate beneficiaries, either it's pensions or it's insurers. Now, because climate conscious investing emerged from the Western markets, the ultimate beneficiaries were more inclined towards understanding what impact their investments are making ultimately, right? So I would say investors or ultimate beneficiaries in markets such as EU have been more conscious in terms of what impact the investments are making. And secondly, the concept of ESG, if you trace the origins of ESG really, ESG investors really believe that if they're making investments which rank high on ESG, in the long run they're going to make better returns, right? That's the basic premise of why an ESG investment is done. And that is why a lot of these investors in global markets have signed up to UNPRI, which is the United Nations Principles for Responsible Investing, or GFANS, that is the Glasgow, agreement of the biggest financial institutions. Essentially, what these things say, or these agreements say, is that we are going to incorporate ESG metrics in our investment decision making process. And then, from the investor perspective, this leads them to provide financing for green infrastructure. But if you see Indian investors, firstly, the beneficiaries, I would say there is no pressure, right, from the beneficiaries to conscious in terms of what impact their ultimate investments are making. Firstly, secondly, if you see investors also of a particular pension fund or of an LIC, these are essentially owned by the government, right? The domestic private counterparts of these companies, they also have investors which essentially do not really care, I would say, in very crude terms, what kind of impact their investments are making. So there is no investor pressure. So, and if you see the membership of UNPRI or GFANS from Indian companies, it's very little. You can just count it on fingers how many Indian companies or Indian financial institutions have actually signed up for these initiatives. And that is because there is no investor pressure to really be conscious in your investing practices. So first is there is no investor pressure. Secondly, if you see what is happening globally, in markets, again, I'm going to go back to EU because that is the origins of climate conscious investing. So in EU, there is something known as a Green Deal, wherein all the investors, they have to essentially disclose what kind of impact the investments are making, right? So what you have to do is, as an investor who's operating in the EU, is disclose that I have done this kind of financing, for example, $100 billion in this particular year. Out of that, let's say $50 billion has gone to the fossil fuel industry, and ultimately that has contributed to this amount of XX% of increase in carbon emissions because of my investment. So what that does is it really brings out in the open what has been the impact, or whether you are actually financing higher carbon emissions globally because of your investment decisions. And that is where then investors would also want to make sure that they do not come in that bad light through these disclosures. And they also want to make sure that ultimately some part of their capital goes into financing carbon mitigation or carbon adaptation projects. Now, and this is from the regulatory perspective. Now, in India, we do not have those kind of disclosure regulatory regimes still in place, wherein a financial institution would be required to disclose what is the carbon impact of its investment. So, both
Got
from
it.
the regulatory and from the investor perspectives, there is no pressure on our domestic investors to do climate conscious investing, and that is where there's no concept of greenium from an Indian perspective.
Yeah, that's fantastic. So we'll come back to this point later as to how to change the incentives so that more people are interested in making these investments. But before that, let's dig into the other big topic that we wanted to talk about today, which is sovereign green bonds, which were issued by the government of India. But before we do that, we'll take a quick commercial break and be back right after. Welcome back to All Things Policy. We are in conversation with Shantanu Srivastava on sustainable finance and sovereign green bonds. So earlier in February, the government of India closed the second tranche of issuance of sovereign green bonds. In two tranches, I think the government issued around 8,000 crores, that is roughly $1 billion of green bonds, and these were oversubscribed. So overall, the issuance was successful, and these sovereign green bonds have been issued under a framework developed by the Ministry of Finance, which sets across different say parameters that go into the issuance, that go into the use of proceeds, that go into the reporting and monitoring mechanism on the usage of the proceeds by eligible investees. So there is this whole new regulatory structure which has come in, and I want to ask you, Shantanu, as to what you think of it. First of all, could you maybe tell us what exactly does this mean? Does it simply mean that the government is going to issue green bonds and these are going to be put into projects and activities which about renewable energy, which are about mobility, which are about any sort of a decarbonization of the economy, so to put it? Or is there something more to it? Maybe you could also talk a little bit about how the government is planning to monitor the usage of these funds eventually over the years. So I'll leave it up to you, Shantanu.
So before that, I mean, let me just talk about green bonds as a concept in the first place. So I think I've covered that a bit in some part of your question before. But green bonds started somewhere around 2007, 2008, and I think the first issuance was by the World Bank. And since then, the growth of green bonds has been exponential. Just in 2021, the total green bond issuances have been over $500 billion, right? And the first green bond issue, considering the first green bond issuance happened in 2007, 2008, it's not been a very long time. It's so in just little over 10 years, we've seen these green bond issuances mushrooming all across the world from all kind of issuers, not just sovereigns, not just corporates, but also municipalities, and also across different sectors. But majority of these issuances have been used to fund renewable energy generation, energy efficiency, and green mobility. So you can imagine why the government of India also wanted to, go ahead with the issuance of a green bond rather than, issuing a simple government security or a GSEC for financing of its green infrastructure plans. Right. So that's the very brief history of green bonds and why, sovereigns across the world are jumping on the bus and, trying to issue green bonds more and more. With the same idea in mind, the government of India also issued its inaugural sovereign green bonds. The total outlay was somewhere around 16,000 crores or close to $2 billion. And these proceeds are going to be used for financing of, like you mentioned, financing of. There are certain categories of investments now. So one of them is, for example, renewable energy generation. Then you also have green buildings. You also have, energy efficiency. You also have electric mobility. So there are somewhere around, I think, 13 or 14 different categories of investments that have been identified and which are going to be eligible so as to be called eligible projects which can be funded by the sovereign green bond. Now, the way the government of India anticipates moving forward in this particular arena is that they have come out with a green bond framework. Right now, this green bond framework is in line with the global best practices in issuance of green debt securities, and they're also in line with the guidelines known as green bond principles or GBPs, which are issued by the International Capital Market Association or ICMA, which provide the best standards in issuance of green securities. So India's green bond framework is aligned very well with ICMA principle or ICM principles. So what it essentially says is that there are four key components of a successful green bond issuance. And our sovereign green bond framework also has those four components. The first component is identifying what assets fundamentally are you going to, fund from these green bond issuances. And that's where, the inaugural green bond as part of the the budget announcement recently on Feb 1st, we saw that from the green bond issuance of the government, the proceeds are going to fund majorly, renewable energy generation projects, but also decentralized renewable energy. For example, some outlay has been done for the Kusum program. It's also going to fund electrification of railways. So good chunk of those, out of the sovereign green bond issuance is also going to help the electrification of the government of the railways. Some part of it is also allocated for, the issuance or funding green hydrogen projects. So the government envisages that, and just to give you an idea, the current outlay of financing of these all of these projects that are listed is somewhere around 23,000 crores as per budgetary documents. And like I just mentioned, the current issuance was somewhere around 16,000 crores. So if you can pick something out of it, I believe the government is going to, and there has been an announcement also, there have been media reports that the government is going to continue with its green bond issuances, right? And that's why probably the outlay that it has provided in the budgetary document is more than the current issuance. So the first is identifying, these categories of investments, and there are 13 or 14, like I mentioned, 13 or 14 different categories of investments that the government intends to make through the issuance of these green bonds. right? So that's one. The second is, if you talk about the four key components, the second main component is what is the eligibility criteria to make sure that the investment that you're making is actually green. Right, so that's where the Green Finance Working Committee comes into the picture, which is inter ministerial committee, which is going to be headed by the CA, if I'm not wrong, which is going to decide essentially which project is green, which project is not green, and then that is going to happen on the basis of a internal eligibility criteria with inputs from different ministries. So, for example, we are very sure that renewable energy generation leads to carbon mitigation. But what about, let's say, green steel? What is the eligibility criteria to determine whether a particular process of producing steel is green or not? That is going to be given by the working committee. So, on the basis of what kind of potential a particular activity has to mitigate carbon or adapt to climate change, a particular project will be designated as green project or not, and then that is going to be funded by the green bond issuance. So that's something that the government has come up with, and this is part of the sovereign green bond framework. The third key component is how are you going to manage the proceeds of the green bond issuance. And for the management of green bond issuances, if you talk about ICMA principle, it really says that because these issues, green bond issues, can be only used, these are only use of proceeds instruments, and they can only be used to finance, eligible projects. You need to be doubly sure where are you going to put this money, and be doubly sure in terms of making sure that this green bond proceeds are not diverted or used to fund something which is it was not intended to do. And that is where the government of India has made sure that the money that it raises through the green bond is put in a particular new account. So new account is being created by the government of India, which is it's going to be put in a different account altogether, more like a escrow account, right, from a corporate perspective. So this escrow account is going to have those proceeds, and then the management of those proceeds are going to be done by the public debt management cell of the government of India, which is going to track how are the proceeds being used, what projects is it funding, and how much of that financing is going to which particular project, right? So all of that is going to be done by the public debt or PDMC of the government of India. And thirdly, it's going to be verified. The fourth key component of successful green bond issuance is how would you verify, right, that whatever claims an issuer is making are actually true. So the government of India has made sure that the CAG of India does an audit of whatever proceeds that it's using for the financing of its green projects are actually going to the intended uses. So CAG is going to do an independent audit of the use of these proceeds and issue, a sort of a certificate or sort of a report that really says that okay, this is the green bond proceeds of 16,000 crores have been actually used for these eligible projects, which are actually a part of the eligible projects that were identified as part of the framework, and it's not being used for any other purpose. So the government has actually made sure that it has a very robust framework in place for the use of proceeds or for the issuance of green bonds. So there is no there is no risk of greenwashing for any kind of investor. And that's where I think the broader goal is to make sure that there is confidence within the investor community, mostly global investor community, in terms of washing away any kind of greenwashing concerns by having a robust green bond framework in place. That's, I think, the broader agenda. And going forward, we would see many more issuances of green bond from the government and probably also from the different municipalities to finance their green infrastructure projects. So yeah, I think to answer the question, the broader agenda is not to stop over here, but also continue with these issuances with a good and a robust framework in place.
Right. So, based on what you said and based on the framework, I had two, three questions for you. So, the first is on the second point of allocation, right? You said there is identification, allocation, monitoring, and verification. So, on allocation, the first question that I have is so, who's eligible get this kind of funding? Is it like any public agency, any PSU, private company, which can go up to the cell, make an application, and get funding if it is found to be eligible? My second question is on the interest, risk, and liability, right? So the government has issued these bonds. So does it mean the government continues to bear the risk and liability, or upon financing some project to, say, a private company which is in renewable energy or energy efficiency, does the interest, risk, and liability also get transferred, or is it more of, or is there some other kind of arrangement there? And the third question that I had was about greenwashing, like you mentioned, right? Now that has been a significant criticism of green bonds, and that really requires our monitoring and verification mechanism to be very strong, and that requires state capacity. So what do you think? Do you think we have enough state capacity to monitor? Because this is going to be like hundreds of projects in the coming years, which is going to be funded by the government through this kind of bond issuances, right? So, do we need to be building more capacity? Do we need to be looking in that direction? So, yeah, what do you think?
Right. So to answer the first question, so how the Green Working Committee is formed right now is that it has representation for different ministries. Right. Now, let's say I'm a steel ministry. I think there is a certain project which is potentially a good candidate to be funded through the sovereign green bond. I'll approach the, or what I'll do is I'll, draft, a proposal. I'll send it to the Green Working Committee, Green Finance Working Committee. That Green Finance Working Committee, on the basis of its own eligibility criteria that it's created, which is similar to something known as a green taxonomy, right, which is going to give you certain thresholds on the basis of which you can decide whether a certain project is green or not. So Steel Ministry submits a proposal of a potential green project. Green Working Committee, Green Finance Working Committee goes through that. It checks with its own eligibility criteria whether a particular project that the ministry is proposing is first of all eligible or not to be funded through the green bond issuance. Sorry, if it's actually eligible, the next step is you make it as part of a pipeline of eligible projects. Once it's part of the eligible projects, then the Green Finance Working Committee is going to check what kind of funds do we have, what kind of allocation can be done to this particular project from the Ministry of Steel, and if required, what kind of new more issuances need to be done depending on what kind of projects it's being getting from all these different ministries. So that's broadly the way or the mechanism through which a particular project will end up getting financed through the green bond issuance, sovereign green bond
Yeah,
issuance.
sorry to interrupt you there. So, I had a small follow up. So, is there any preset allocation between different ministries or different kind of projects? For example, 2,000 crores for energy efficiency, 2,000 crores for water management. Is there something like that, or it's going to be a case to case decision?
So, like I mentioned, the budgetary outlay as part of this year's fiscal budget, that provided some idea in terms of where the allocation is going to go. Right. So, like I mentioned, a good chunk of that, I think somewhere around 4,000 crores for renewable energy generation, which is allocated to MNRE. Some part of it also goes to Kusum, financing the Kusum scheme. Some part of it goes to Ministry of MUHA. Some part of it goes to the Ministry of Railways for electrification of rail infrastructure. Some part of it also goes for, like I mentioned, financing green hydrogen. So we have some idea in terms of what the financing is going to be done. But there was no, if you look at the green bond framework, right, it does not specify that this is going to be the allocation, right? It's going to be on a case to case basis, and those cases are going to be within the 13 or 14 eligible categories of investment that have been identified by the green bond
Got it.
framework. Yeah.
Yeah.
So, and then I think the second part of the question was, does the interest rate risk being is going to be transferred to the ultimate beneficiary of those green bond proceeds, right? So, see, the way India's sovereign green bond issuance is being done, I don't think so. There is going to be any kind of interest rate risk transfer in the first place, right? Secondly, if you see the prepayments of the coupons and the principals by the government for the issuance for the issuance of this particular green bond, they are not going to be linked to individual projects. For example, let's say if there is a 2,000 crore outlay that has been given to Kusum program, it's not going to be like the cash flows that are going to be generated from those particular projects under the Kusum scheme are going to provide for the repayment of the coupons and the principal, right? So the repayment of the coupons and the principal is not linked to individual projects. So that is where the government also has the leeway to provide for R&D projects, which end of the day would not generate any kind of cash flows. Right? These are demonstration projects or projects which are trying to develop a particular technology. So there is not going to be any kind of risk transfers. Firstly, secondly, the proceeds are not linked to the success or failure of individual projects, and hence you can take a vast kind of a large number of different kind of projects, and even if it does not work, the government does not link it to those particular success and failure factors. So I think that partly answers.
So the way I understand it is essentially it is budgetary outlay and subsidy support under a particular central scheme, which is being funded through the issuance of sovereign green bonds.
Exactly.
Okay.
And I think the third question you had was on greenwashing concerns. Am I right?
Yeah.
All right. So, see, in terms of greenwashing concerns, like I mentioned, it is very important to first of all have a robust green bond framework, right? And India's green bond framework, it's been there's an independent agency, global agency CICERO, which provides a second party opinion on green bond frameworks, and that has given light green shade, which is a good ranking, a good rating to India's green bond framework, right? So in that sense, we have a robust framework in place, right, which is ultimately going to help subside any kind of greenwashing risks, right? So that's one that is very important. Secondly, a second important thing to make sure there is no greenwashing, that is going to happen, or there is no greenwashing concerns with the investors, is that the eligibility criteria that you have, right, is so robust that it does not allow any kind of the activity which has potential to, let's say, extend the life of a thermal assets, for example, or provide financing for any kind of asset which which cannot be essentially called as green happens. And that is where India, if India had a green taxonomy in place, it would have been very helpful in making sure that we have a robust eligibility criteria in place. But right now, as it stands, the Green Finance Working Committee is going to is going to have an eligibility criteria which is not being disclosed to us. What exactly is going to be that eligibility criteria, the threshold on the basis of which we are going to decide what is green and not green. And that is where I think more disclosure is needed. And that is where let me give you an example. For example, if there is an energy efficiency project, now if a thermal asset is, we're going to fund a thermal asset which is going to be more energy efficient, that is essentially going to extend the life of that thermal asset. Even though the project is going to become more energy efficient, it's going to extend that life. And a lot of investors today would not want to fund any kind of asset,
Correct.
irrespective of
Yeah.
whether it improves the efficiency or reduces the efficiency, if it's linked to a thermal asset, right? So we do not have the knowledge of how that eligibility criteria is going to work. And if that is not out in the open, right, there might be some greenwashing concerns from the investors, right? And I think on that particular front, the green bond framework really does not rank very good. So overall, I would say it's a robust framework. We have good, management of proceeds, verification processes. But when it comes to eligibility criteria, or so as to say a taxonomy, we need to do more. And subsequently, what I believe is that we are going to come out with a green taxonomy, and the green bond framework might ultimately use that as a base for deciding what is green and not what is not green.
Right. So thanks for going into such details of the nitty gritties of the sovereign bond framework and explaining to me and all of us listening. So before we close, I have one final question, and this is something we were talking just before the break, and that is about the supply side of green bonds, right? So essentially, how do we ensure that more people are ready and willing to invest in these? Because after all, these are going towards our fight against climate change, which is essentially a battle for survival for humanity as a whole. So you mentioned there are three problems. One is that there is this perception in the West and other countries that investing is in green projects is a good payoff over a long period of time, which is why there is more attraction towards green bonds, which does not seem to exist in India as yet, or at least not in sufficient quantities. And the second thing that you mentioned was there is not much investor pressure, right? We don't have like associations of employees going like, oh, our EPFO funds at least 20% should be going into green bonds, right? We don't have anything like that. So the investor pressure on institutions which have a lot of capital for investing is missing. And I think the third point that you mentioned was about the disclosure regime, right? And which is essentially a form of naming and shaming, which is like saying, oh, look, your LIC or XYZ has invested 30% of its capital in polluting industries, right? So that can act as a incentive in the markets to sort of make them change their tracks. But this kind of disclosure regime, at least an advanced disclosure regime, does not exist. So these are the problems that you laid out. So maybe could you walk us through what is your take on this? Like, how do we realign the incentives of investor? Because I think ultimately this is a supply side problem because we have enough demand already.
Right. So let's take it one by one. The first problem that we mentioned was, there is lack of investor pressure, right? And that also links to, why we do not give Indian investors do not give any weightage to a greenium, right? So how do you make sure that there is investor pressure. Now you cannot ask any investor. For example, let's say you have an ICICI Prudential, right, which is one of the leading insurers in the country, probably majority owned by the ICICI Bank Group. You cannot ask them, right, that why are you not, more conscious in your investment decision making process? Why are you not asking your investee companies to be more responsible, right? An investor, end of the day, is guided by profit making, right? And for them, their responsibility also lies to the shareholders, right? So again, the biggest goal of any corporation is shareholder wealth generation or maximization. So from that perspective, I think investor pressure is something that we cannot expect that is going to just come out naturally within Indian companies or Indian investors, right? Second thing is, you cannot also expect that a certain set of, let's say, EPFO beneficiaries come out and say that we want you guys to be more efficient and more forthcoming in terms of your investment decision making process, to also include climate considerations. I don't think so that's going to happen, right? And that's probably part of utopian idea. But what we can actually do in terms of making sure that domestic financial institutions end up considering climate change or ESG perspectives in the investment decision making process is through the regulatory approach, right? Wherein, like you rightly mentioned, you could have a name and shame kind of a regime wherein you have to disclose what is the impact of your investments in terms of its carbon standing, and you disclose that to the world, right? So that your operations, your investment decisions are being scrutinized, right? So that's one regulatory, and that's only disclosures part. Second is the big institutional investors. The banks are regulated by RBI. The pension funds are regulated by PFRDA. Insurers are regulated by IRDA. Now, IRDA, PFRDA specifically define the investment guidelines, or the investment process for their regulated entities like the LIC or the EPFO. Right. So from that regulatory perspective, it's important that there is some incentive provided, first of all, to IRDA, PFRDA, to go out and actually consider the green investments as eligible investments that they can make. Right. So first of all, include those investments as eligible investments. Right. Have certain mandatory allocation for green projects within those investment guidelines. For example, let's say a PFRDA or IRDA says that 10% of yearly cash inflows for their regulated entities have to be mandatorily be invested in some sort of green security, green debt security, right? So this is a very simple example of what kind of regulatory or investment guideline change can be done, right? Which is going to ultimately nudge all these insurers and pensions to be more conscious in their investment decision making process. Secondly, from an RBI perspective, what RBI can do, and they've been, if you see the sovereign green bond, the green bond proceeds were eligible to be classified as eligible for SLR, a statutory liquidity requirement. So if a bank in India subscribes to the sovereign green bond, it can use those bond holdings as eligible securities under SLR. Similarly, there should be more prudential regulations from RBI and more monetary policy kind of changes, which are going to ultimately nudge the banks. And we have to follow both a stick and a carrot approach. From a carrot approach, it should incentivize banks and other NBFCs to provide more and more financing. One of the avenues is priority sector lending, for example. That is an idea that we have experimented with a lot previously. Secondly, what you could also say is that if, let's say, a bank provides X% of its investments in terms of bonds, if those are green bonds, the requirement to provide upfront capital is going to be lower, right? Or if it's any kind of green security, the requirement to provide upfront capital is going to be lower, right? So that way you give a carrot approach, and saying that if you invest more in green bonds, you invest or provide more green loans to your customers, we are going to so as to say, reduce the requirements that you have in terms of providing more capital buffers. Secondly, what it could do is, and this is a stick approach, is if operations that you have, let's say there is a certain threshold of carbon emissions that can come from your portfolio. If the carbon emissions of your portfolio, of your lending portfolio, is higher than that particular threshold, there is going to be a certain penalty on you, right? That again is going to be a stick approach, wherein it is going to incentivize a particular bank to make sure that the overall lending portfolio it has, is a mix between providing for fossil fuels and also for renewables, right? So I think the way that we can make sure that Indian investors provide capital and Indian financial institutions provide capital for financing India's green infrastructure development is through the regulatory approach and not from the investor approach.
Right. So those are some interesting ideas that you have laid out, and I definitely believe green bonds are a very exciting space today from both policy maker and policy analyst perspective. We have to close now. Thank you so much, Shantanu, for joining me on this conversation. I learned a lot, and I'm sure our listeners will benefit from this discussion as well. So thanks once again for joining me.
Thank you, Shrikrishna, and glad to have this conversation.
If you liked our show, don't forget to check out other interesting podcasts on the IVM network. You can tune into them on the IVM Podcast app, ivmpodcast.com, or wherever you listen to your podcasts. You can also follow IVM on social media. The handle is @IVM Podcasts on Twitter, Facebook, and Instagram. And hey, if you'd like to dive into Takshashila's research on technology, strategy, and economic affairs, check us out at our Twitter handle @Takshashila INST or our website takshashila.org.in.